with all that's going on today, it was a little jarring for me to hear the opening today that Laurent was going to maybe or maybe not do the conference, and then the second, panel was about, is fintech a fad? Is it a buzzword? So, maybe we should all just close up shop here, guys. I don't know. But anyway, we have a wonderful panel up here today. I'm going to let everyone introduce themselves real quick, and then we'll jump into it all the way down the end. Tom, Stafford.
Hi, I'm managing partner of DST Global. We're a global internet and technology firm. I run our European business and our global fintech investing business.
Hi, my name is Emmeline Shaw. I'm the managing partner of a fund called Flourish Ventures. We're a $500 million early stage fintech fund focused on advancing financial health and economic resilience.
Hi everyone, my name is Tim Sievers. I'm founder and CEO of Deposit Solutions, and we bring open banking to the product category of savings deposits.
Hey everybody, I'm Matt Oppenheimer, co-founder and CEO of Remitly, and we're transforming the lives of immigrants and their families by providing the most trusted financial services on the planet.
Hi, my name is Koppel. I'm the founder and CEO of Monese, which is a banking service that operates across Europe right now and making things such as accounts, cards, and everything else accessible and very easy for customers.
Thank you all. Matt, I'm going to start with you. This panel is sort of about globalization, starting businesses that are global, differences between starting in the U.S. or Europe. But you're the crazy man up here. You ambitiously started 9 years ago. You've now gotten into 700 corridors. You're in 60, 70 countries. What the hell were you thinking? Yeah, that's a pretty big challenge.
Yeah, so I started the company living in Nairobi, Kenya, where I saw how painful it was to send money internationally. And while we'll be doing broad financial services over time, remittances are our bread and butter. So I moved back to the U.S., where I'm from. That's where we started the company. And I'm a firm believer that most globally transformational companies have really audacious visions, but start with focus. And so we focused on the U.S. origination first. And we just sent money to the Philippines. And actually, within the U.S., most of you probably know this, as a money transmitter, it's counterintuitive. You'd think you'd need one license. But we started just in the state of Washington because you have to get a license in every single state separately as a money transmitter. And so I think that focus was helpful. We always had the bold ambition, and where we've come now, 700 corridors. We're sending over $6 billion a year. But we started in the U.S. just because that's where I was from. It's the largest remittance country in terms of where funds come from, and then since then we've expanded to Europe, APAC, et cetera, from a strong foundation.
What were some of the challenges when you looked at that? I mean, the regulatory compliance. What was the toughest thing?
Yeah, I call it a bunch of chicken and egg problems because when you're starting a money transmitter, especially in the U.S., you have to have capital for net worth requirements with state regulators. You have to have a product that regulators can audit. You have to have a product to raise capital. You also have to get partners to disperse funds, and they want to see some sort of license or anything. And so you had all of these, and I think it was actually the combination of compliance, capital, product, fraud systems, treasury, all those things combined, and just trying to do them all at once, which you're going to have to do to get off the ground.
Norris, you've been through the same thing in a bit of a different sense on the digital banking side. Talk to us about that.
Yeah, I fully agree with what Matt just said. So we started small as well. So we chose UK as a launch pad because the regulator was incredibly friendly. Fintech was booming. Access to capital was enormous. So we started in the UK and then quickly expanded to Europe as well. So today we are available across Europe. But our ambition has always been global. So my personal goal is to get to cover as many countries out of 200 countries as quickly as possible. So it's about sort of an 8-year target at this point. And we found it that in order to actually be truly international and truly global, you have to start from scratch, from thinking, how do you build your platform? How do you build your licensing aspects? How do you build it up from scratch in a way that actually enables you to get there? We have seen many operators in this space who basically go deep in one country, and they find sometimes that they're coming out of that one country and go to another one. It's actually quite challenging. So I think it's important to get your foundation right. And right now we have found a solid foundation, and we are scaling from there really fast now.
Great. Emmeline, you invested in Chime pretty early on. In one country, the United States. Was it just easy for Chime? I mean, they're now $5-6 billion in value. One country.
So maybe just some context. We invest across a number of markets, so India, Africa, Latin America, other parts of Southeast Asia, and then half our capital in the U.S. When we looked at challenger banks in particular, we started actually looking at the market, and it was pretty clear that Europe and UK in particular was the right market to at least start making bets in this area. So we backed Tandem, thinking, and really with a focus on getting a license, thinking that would be the right way, the process to get a bank up and running to provide these digital services. I think we learned that that's a long process, takes a long time, costly, and Ricky and his team have done an amazing job, to actually innovate and provide an incredible bank out here. But what we did learn through that was how do you take the opportunity set and approach it in different markets where we don't have the costs and the infrastructure, et cetera. So we came in and Shannon took the banking license and rented a charter and, partnered with back-end processors and used that as our focus as we thought about the US markets and beyond. Chime was one of the first. There were many at the time. It was very unclear. Unit economics were unproven. But what was very clear was they were an incredibly talented team. And Chris Britt in particular had experience selling into the market of the mass LMI consumer, low to medium income consumer, through his work at Green Dot. And beyond that, he understood the relationships in particular that are required on the back end with Galileo as a processor and how to structure those economic arrangements at scale in a meaningful way. And it's that faith and that ability to kind of address that consumer and get the unit economics to work in a pretty short period of time that really shifted their value prop and their ability to really scale pretty considerably in the US much earlier than their counterparts.
Exactly right. And Tom, as a VC like Emmeline, you get to sort of sit back, watch all these guys start these businesses. You got the easy job. You just get to pick and choose what countries, what bank. I'm kidding, obviously, but you've invested in not only Chime, but Revolut, Nubank. You've picked a lot of great winners. How are you thinking about the sort of global vision of someone like a Revolut versus a U.S. vision for now on someone like a Chime versus emerging markets? I mean, you're really spreading your bets around.
So I agree that our job is a lot easier than building a company. So that's definitely true. I think first off, I think the job of the investor is not to dictate how or what the company does. Our job is just to be a resource and a support to whatever the founders want to do with their company. So if Nick wants to take Revolut into 198 countries, then our job is to help him achieve that. If he wants to get to 8 countries, our job is to help him achieve that. I think for somebody like Revolut, as they think about sort of expanding globally versus, say, Chime, who's obviously expanding very rapidly across the US, there's also a difference of just size of market. I mean, Revolut's coming from the UK, which, sure, it's a big-ish market, but in terms of order of magnitude, smaller, essentially, than the US. And so if you're going to build a very large company from the UK or from France, you're generally going to think pretty quickly about expanding and having multiple geographies. That's maybe an advantage of Europe or a disadvantage. I mean, everybody can have their own views. But I think for most ambitious founders, starting in a European country, you always think, let's go and do multiple countries, because it's the only way to get to very large market caps. So I think it's also sort of where you start from. And then the second question, a little bit what we were talking about just now about regulatory, is how do you manage multiple countries with regulatory and compliance requirements? And I think starting from the UK is a bit of an advantage in this side because generally most global regulators kind of respect and recognize the work of the UK regulator in banking. That would also be true of the US regulator, but actually their companies don't go as global. But if you're starting from, frankly, Italy, it'll actually be much harder for you to passport that license, and I don't mean that in a technical way, in a sort of a more philosophical way, to passport that license to a Brazil or to a Singapore. Whereas passporting a UK license or relying on the UK regulation, actually most regulators around the world will respect that. So I think that's a second advantage maybe of coming from Europe, particularly the UK.
Why do you think it took so long for the challenger bank market to take off? I mean, I've been chasing this space, looking at it since the mid-'90s at Goldman. And nothing really worked. You had ING Direct, but it's just in the last 5 years, some of these banks have really taken off, and you've been really, I think, studying them more than anybody I know.
Well, let's wait and see. Let's not say it's anything's been achieved yet. I mean, we're all piling lots of money into these companies, and they're all building great teams, and the founders here are building great teams around them. But ultimately, the EBITDA of all of these businesses is still negative. I was going to say de minimis, but let's be honest, it's negative. And in the context of sort of banking, the 12 or 13 trillion dollars market cap of banking, I mean, this is a fly in the backside so far. So I don't think anything's been achieved so far. We're just on the very, very early stages of it. But to your question about why now, I mean, the guys will have a better view than I do, but I think it's a combination of some of the infrastructure tools haven't been built. We just mentioned like things like Galileo or Plaid or indeed deposit solutions. So if you are starting a neobank now, you can plug into deposit solutions and have a way in which you can offer a savings product to your consumer without really building a lot on your side. I mean, it's all built for you. It's very different than 5 years ago. None of this stuff existed. The second thing is there's actually some competition between regulators, which is great. So you see, the German BaFin coming out now saying, start your neobank here. We want you here. Or France saying the same thing. And for example, France being very, very proactive with Quanto, one of our portfolio companies. So I think there's competition amongst regulators, which helps you get the licenses. And then frankly, the third thing is there's an ability for people to raise capital. So there is a lot of money focused on this space today. And I think, as Matt said, unfortunately, you need capital to build these businesses, and there's a chicken and egg problem, and I don't think the capital was available 10 years ago. So I think it's a combination of sort of infrastructure, regulation, and capital.
And I just also add quickly that mobile phone revolution also has really helped. So when we started thinking about this back in 2013, I mean, the speed of internet for mobile phones and iPhone and everything was readily available, and that was never the case in the past. So I think that usually has helped as well, because it's just so much more convenient than ever before.
Yeah. Tim, let's shift it up with you a little bit. You're more on the infrastructure side. You're working with a lot of incumbent banks, some challenger banks as well. How is it different for you, sort of not going after the consumer? A lot of these guys talk about consumer businesses. You're more B2B to C, if you will. But your business initially is all pan-European, and now you're moving over to the U.S. Give us a bit of your journey compared to some of the comments up here.
Yeah, of course, happy to. So I also started 9 years ago, actually. As important it is, I'd agree with what the previous speaker said, that it's important to think global from the beginning. To be honest, I was really focused on making this work in the German market first, because getting that product market fit wasn't an easy thing to do. Also, aside from all the problems that you always have when starting a kind of marketplace type business, where you have to sort of build two sides at the same time and overcome this chicken and egg problem, in fintech you also have the regulatory differences in different markets, right? So that was our first step, and it took me 3 years or so to really take our full proposition to market, and then scale it out across Europe, and now into the US. We're in 18 countries now in Europe, so we are quite international, but it is, I think, an illusion to think that expanding within Europe is like expanding in one market. This is really, our experience has been that while there are European directives, the national implementations deviate, you have to interact with each national regulator. It's, I mean, like literally waiting for months and months for like replies to simple letters, trying to get meetings. There's so much red tape, and there's so many obstacles that really entering, say, from Germany into the French market was an exercise that took us just as long as it is now taking us to move into the US. And I think that's really the big disadvantage also from my perspective for a European fintech, because you don't have that large home market. And I realize that in some product categories, you have to, like in the US as well, go from state to state and have different licenses too. But from our, firstly, for our product category, that's not the case with the setup we have developed for the US. And secondly, even that I think is quite a bit simpler than going from one European country to the next. So this, I think, is definitely a big challenge that we have felt.
Talk about that jump over to the U.S. You haven't really seen too many businesses go from Europe over the U.S. and succeed, right? I can name some ones that haven't, but what do you think it takes?
Yeah, there is this saying where like it's sort of German businessmen tend to fly first class into the US and economy back, right? And we didn't want to be one of those. So we spent quite some time researching the market, customizing the product, making sure we can have a product market fit in the US, and and that involves sort of slight changes to our proposition. So we've done a lot of that. At the same time, it was important for me to be able, essentially, I mean, we don't want to go away from what we do, and we are also going to settle our US business on our technical platform. It's going to be processed in that same core, and it was always important to us also, I think also like for the commercial afterwards, it's important to be able to use that infrastructure. That's essentially what we are building, right, with deposit solutions for open banking, to be able to use that also in the US instead of having a parallel build there, because that would just not make much sense commercially.
If I may add something also, what we have found out, that people think that Europe, as you said, people think that Europe is one of this big warm and cozy place where everything is identical, but it's not. So what we have found out by, we have mapped out next countries where we want to expand, and we have found out that, for example, US, which seems to many people as obviously it's a difficult market and whatnot, cultural differences and licensing, but we have found out that, for example, expanding to Poland within Europe could be much more challenging than expanding to US if you just ignore the cultural differences, but you focus on sort of, for example, readiness of partner banks and readiness of regulators. So it's quite interesting.
Let's shift it up a little bit. As I've been out talking to a lot of these challenger banks and other fintech companies, I'm starting to hear for the first time ever some bravado about building $1 trillion, global digital bank, right? Not from just one party, but multiple. Tom, having seen so many of these, and you're seeing so much money, you said it's going to take a lot of money. We talked about this the other day. What do you think the odds are that just one of these digital banks that has been here at this conference becomes $1 trillion company in 20 years? Pardon me? And which one?
Well, I'm definitely not telling you which one, because I want to be the investor and hopefully own.
Because none of them are worth more than like 5 or 10 today. So there's a lot of money to be made if that's the case.
Still never give away your secrets. I don't know how to judge the probability of $1 trillion. I think a more realistic hurdle for us all to think about is $100 billion market cap. And if you think about the size of the prize, if you like, in monetary terms, i.e. roughly between 12 and $15 trillion in market cap, there should be at least 10 $100 billion fintechs within the next 10 years. Now, we already have 2/3, which is PayPal and Tencent's sort of internal piece. I expect there to be at least another 7 or 8, and maybe up to 12 within 10 years. That I'd feel 80%, 90% certainty on. Probability of $1 trillion in 10 years is pretty small.
If all 10 merge.
I think the likelihood if all 10 of
No.
those merge, there'll be less than $100 billion.
There you go.
The fact is that if the founders don't drive those companies, they won't get anywhere close to $100 billion. PayPal's got to 150, 125, or whatever it is, over roughly 20 years. If this panel or the other people presenting at this conference want to do it in a shorter time period, let's call it 10 years, 5 to 10 years, it's going to have to be founder-led. That's the truth of all of these big tech companies, Google, Facebook, Alibaba, Tencent. They're all founder-led, which is why we only invest in founder-led companies. And so I think if they merge, they won't even get to a cumulative $100 billion.
There you go.
And I don't expect them to merge.
Emmeline, how about you?
Yeah, I think I agree with Tom. I think that the reality is we're at 7 challenger banks right now globally across India, Africa, 2 in Latin America, 1 in Brazil, 1 in Mexico, 2 in the U.S. So we've got enough. And if the question is how many of those are going to end up in that order of magnitude, I think there's going to be few. And I don't think they need to be $1 trillion north of that to be able to be successful. I think you're going to have a couple, and it's clearly the 100 billion and above. And I fully expect that. And I think beyond that, it'll be a much broader set of fintechs that will hopefully fill in the void. And the reality is, look, this is going to be, it's imperative for these founders to lean in, to get the right talent to scale, to build the trust, to compete against the big tech platforms, to compete against the incumbents. And I think it's going to take a lot of a high degree of strategy, a lot of capital and commitment, and really, really, to your point, decisive strategy as you enter into these key markets like the US and parts of the UK. So my bet would be similar to two or so north of 100 billion of kind of challenger banks, and then probably another 10 or so fintechs that are going to be in that realm. And as an early stage investor, that is perfectly a win as far as I'm concerned. So, and I'm excited to see that pan out for you guys.
Norris, you're chomping at the bit there.
Yeah, I just tried to do mental math here. So, for example, in order for a company to reach that scale, based on current valuations, I'm seeing that this company, assuming that nothing changes, everything is sort of a flat, this company needs maybe 100, 200, up to 300 million users. So how do you get to that scale? UK? No. You have to be international and global in your mindset, and you have to scale really aggressively in the coming years. So I think those people who are, and those companies who are, have a global mindset, they have a pretty good success. I think it's more likely that these companies will ever reach this.
Well, it completely depends on what product offering you have for those users, right? So clearly the three fintechs that have made that $100 billion club so far have done exactly as you just laid out, i.e. 100 million plus users, PayPal, Ant Financial, etc., with very minimal monetization per user. I think the last time I looked at it, PayPal makes around $8 or $10 net income per user per year. So very thin, but spread across a huge number of users. Flip side is a bank with a full stack service, so like a Chase or a HSBC, makes hundreds and hundreds of dollars in net income per user. So like 1 to 2 orders of magnitude more net income per user. So the real question, I think, if we drill down into the detail of like a $100 billion club or even a $10 billion company or whatever it is how is the business model going to make money? And I think that's actually gets lost in a lot of this talk of $100 billion and 100 million users and whatever else. The fact is that most services that are in existence today by neobanks, even with 100 million users, will struggle to get to $100 billion market cap. When we start to think in PE terms, in EBITDA multiple terms. So I think there's still a huge evolution needs to happen in how these neobanks make money. And they do fintechs, because we're way off the sort of net income per user we need.
Tim?
Maybe just adding to this, because you are talking about the B2C angle now and that part of the market, and just sort of for the B2B and infrastructure part of the market, I guess the opportunity is twofold really. One, it's a very large market, and I mean, depending on which product category, of course, but looking at deposits, for instance, we have 10,000 billion euros just in the EU alone. The US is even a little bigger. So you've got large markets, and then you have a situation where the value chain is currently handled by legacy systems, outdated IT systems, sort of processes that were designed in times when people were still using paper-based processes. And I think with what technology enables today, you can replace and make more efficient many of those processes. And there is the combination, I think, of huge market, a sort of underserved situation to begin with, and then a technological environment where you can sort of start to develop standards and start to sort of fragment the value chain a little bit, take out bits and sort of build them out to utility services rather than everyone doing them themselves. There is a huge opportunity, I believe, also not just in the B2C space, but also in the sort of B2B infrastructure space, which is why we chose, although we also have one B2C distribution sort of subsidiary called under the brands of Zinsbüro and Savedo. That's, I guess, the logic why we chose to focus on the infrastructure side of our business.
Yeah, I would love to just expand on both comments. I think specifically as it relates to infrastructure, the ability, I think that over the next 5 years, so much capital and innovation is going to be in the infrastructure side, and so much value is going to be extracted through that to be able to unlock and realize a lot of this functionality. I think in the UK with open banking, you have so much opportunity to really build infrastructure and middleware to enable, and it's a layer that is missing. And certainly as you extend into the US and markets that don't have nearly as advanced regulatory regime, I think there's gonna be so much benefit. And so our thought is, I mean, even if you think about banking as a service as the most basic, in the US, for example, Synapsify is kind of the product of choice these days, and they are failing to deliver across so many dimensions, and yet have unlocked some real opportunities among fintechs. And that's just one example of many. And I absolutely believe there's so much infrastructure and so much value will be created. I think as it relates to consumers, I agree with you as well. You know, I think we are, if you think about interchange models in the US, that works. If you look in LATAM, that works. If you look beyond that, a lot of these other models are forced to evolve. They're lending in some cases in Africa and others as their kind of entry point. You have others that are subscription models here in the UK. And it's unclear whether those are going to be sustainable. And I think we know that they're going to have to innovate. Even the interchange models are going to have to innovate. And the question is, what do you layer on top? Is it lending? Is it others? And once you go in that dimension, you end up having it being treated like a bank. Not only do you have the regulatory pieces and constraints, but you actually get valued differently. And that is another question at hand, is this an M&A, whether it's a strategic value in a markup, or is this an IPO, at which point, who knows how some of these companies will be valued. So there's a lot to consider as you think about challenger banks in particular and how they have to innovate to create the value that would justify some of these exits we're talking about.
Matt.
The biggest thing that's been going through my mind as we've been talking about the kind of 100 billion, and I agree that's kind of more tangible and achievable than $1 trillion, and I do think that there will be some fintech companies that are created in that space, is a whole heck of a lot of customer value has to be created first and foremost for there to be a $100 billion business. And the interesting thing when you think about the examples of Ant/Alibaba, Tencent, those, and PayPal even back in the day, went from really cash, a really non-optimal solution. When I was living in Kenya, seeing how M-Pesa transformed domestic financial services because it was going from cash to something that was fully digitized, solved domestic remittances, solved a bunch of like really significant pain points. And when I see things like when Apple Pay came out back in the day, it was just as I had gotten back from Kenya, I was kind of like, it's not that painful to pull out a card. Of course, it would be better if I could just use a digital payment, but if there isn't that kind of step change, then I think it's hard to get the kind of $100 billion of value created. I do think that some companies, if you look at some of the specific issues that our customers face, if you think about immigrants moving to a new country, getting access to financial services, getting a bank account, having the right lending products without having credit history, certainly sending money home, which is primarily what we do right now. There are step change benefits for the 250 million immigrants that live and work outside the country they're born. So that's why I'm really optimistic about the space we're in. And I think it's really important for any fintech to say, is this marginally additive? Because if that's the case, getting to 100 billion is going to be a really long journey. Or is this transformative in terms of the value that can be created ultimately for customers?
Yeah.
I think, by the way, just to touch on that, Matt, I think what's really interesting is there used to be this like VC sort of wisdom. There's no such thing as VC wisdom because we're not wise enough, but a VC adage that was like, the product needs to be 10x better to really scale or take off, right? And to your point, like what Ant built in China is not just 10x better. It's like there was nothing there before, so it's an infinitely number of times better. Many neobanks are, and indeed infrastructure plays are improving, but they're not 10x better. Yet they're scaling very well. So what does that tell you? I don't know, but it's a very interesting sort of change of view you have to have as the VC, because you're not backing something that is 10x better, it's maybe 2, 3, 4 times better, yet people are adopting and scaling very quickly. And so as an interesting question is whether there should be a new mindset from the investor side at least to say it's not value creation, it's value transfer. Because you use the word to create $100 billion of value. Actually, is it just a transfer of $100 billion market cap from the existing incumbents? What Ant did was it created $100 billion or $300 billion market cap because it didn't exist in China. But in the case of Europe or the US or Latin America, I mean, in Latin America, depending which way you account for the state banks, the market cap of banks in Latin America is around $700 billion US dollars. It's already there. So if a new bank can get 5, 10, 15% of that market share, then they create that. So it's a very interesting question you've just raised, because I don't have the view yet, but it's very different than thinking about social networks or e-commerce, where the products were literally 10x better. These products are generally 2, 3, 4 times better. Better, but not 10x better.
But Tom, think about this. You guys talk about these $100 billion companies that are already there, Ant Financial, PayPal, et cetera. They wouldn't have gotten there without Alibaba and eBay, right, and others, right? So, is it possible for someone to do it on their own? Are we going to see the e-commerce giants come in and do something here? They've got all the data, they've got all the money, they've got global access. Google. There's a lot of murmurs of what they're doing behind the scenes. Facebook's trying stuff with Libra. There's been successes, there's been failures, but do you see any of the big e-commerce companies in 15 years, let's say, actually being meaningful in financial services? And I'm sorry, the ones that are not already in it, let's say US.
Yes.
Which one? You don't have to pick. But
Amazon, very
likely.
likely.
They do that by buying someone, like eBay did with PayPal.
I think they will make acquisitions as they roll forward. And I think there will be a lot of acquisitions, because after any splurge by the VC investment community, and there has been, let's be honest, like a nuts, ridiculous splurge in the last 2 or 3 years into fintech, it breeds a lot of companies, and not all those companies will be able to be successfully independent. So there will be a lot of things to buy, so there will be acquisitions. But I think the likes of Amazon, we were chatting about it backstage, they have data to enable them to build it for themselves. I mean, ultimately, they see all these transactions, either on the consumer side or the B2B side, the marketplace side, that can enable them to do very smart things around lending, very smart things around payments, very smart things around insurance. So I think Amazon is sort of already beginning to dip its toe. Whether Google and Facebook, how far they go, I'm still a little skeptical, just because of the regulatory overhang they already have in their core business, and then adding this would be, I think, maybe a step too far, but we'll see.
Yeah, I mean, just to add to that, the two things in my mind that are driving this are, of course, the customers they already have and the brand and the trust, but then secondly also access to information that helps them price credit risk better. And I think that's really the strength of some of those players, that they have both. And plus technology and no legacy systems, so they are going to be formidable competitors to some of those incumbents, I think. And I just wanted to add one point to what Matt and Tom said earlier on the value drivers, the drivers of value creation, because I found this a really interesting point: is their value created or redistributed? But I think on top of what they said, there is one more thing going on, and it's even if you consider a certain revenue stream in the industry and assume it's unchanged, so there isn't even additional customer value being created. Let's just sort of assume these products aren't really doing much for the customers in terms of sort of genuine like 10x value creation or so. I think they probably do, but just assuming that doesn't happen, there's this other thing going on, which is a sort of a deduplication of infrastructure, and you can just take out costs out of this industry like massively. And that will affect, that is value creation, right? There are going to be higher EBIT and cash flow streams. And just taking again the example of our platform for deposits, it's previously the conventional way of running deposits, 5 banks, 5 savers, 25 accounts will be run. Every bank does the same thing for every saver, right? You plug a middleware in the middle of this value chain. There are 5 accounts that are being run. It's the accounts that these guys had with their home bank anyway, and then they're using a couple of products, right? And
do you know anybody that does that?
So you're deduplicating retail infrastructure, and that takes a lot of costs out of the system. That drives valuations as well.
So long as depending on how much of that gets given back to grow. So of course, one of the things that fintech has done, the same as Amazon did in e-commerce and indeed Google did in search and Facebook did in social, is they create this enormous value, as you just outlined. That's a 80% reduction in the number of accounts, right? That has value. But then to grow, we're all complicit in this. We give that value back to the customer in order to attract the customer to our products, right? Which is the right thing to do. But what does that mean in the end? If we keep giving back all the value we're creating, then there will be no unit economics.
Yeah. No,
Because
you're right.
if you create a much better way for FX, but you then give back that saving consumer, which is the right thing to do, but maybe not from the long-term economics of your business, right? So I think there's still a huge question in my mind, at least, of like, what is the long-term unit economics of fintech versus banks? Because the revenue pool may not change, but the net income pool could change very drastically if we give a lot of this back as free giveaways.
Well, Tom, you're touching on an interesting topic, which is eventually a lot of these digital financial services firms are going to have to figure out how to lend money, right, in order to make money. Because you can't interchange yourself to a $100 billion company, in my opinion. So, Norris, I'm going to ask you a question. So you're building this cross-border, digital bank, digital financial services firm. At what point do you guys get into lending, and do you feel like that's got to be a big part? And you don't have to talk so much about Monese, but the rest of digital banks in general. Is lending a huge part of their income statement in 10 or 20 years if they're going to be successful?
Yeah, I think we are in a sort of very, very early stages of neobanking at the moment. So many people have done payments and so on, but credit is not really quite happening. There is nothing new out there, right? So I think whilst when we look at global players like ourselves, I think when we look at local banks where things are going a little bit wrong is that a typical bank is basically contains many different databases. So customer data is in multiple places, and it's very difficult for banks to lend and serve the underserved, for example, so people who are from abroad. So I think in the next 5 years, I would predict that, and definitely want to contribute to that as well, is that companies like us and big tech will go heavily into credit because the database is how we collect data is significantly different. And I would bet that we are able to make much more sense and make credit accessible to those who would be underserved at this point of time. And also we are able to lower the credit. And I would be hugely surprised if fintechs and I would say also big tech don't go after credit in that way, thanks to the abundance of data that we are gathering.
I'd say there's already a lot of risk in these models, just given how early they are and how much money they're burning. But if you start getting into the lending business, you start entering into a lot more risks of, capital availability. Obviously, credit crisis. We haven't lived through one of those in 10 years. So, who wants to comment on, the level of risk and the sustained level of risk of actually really being a lender at the end of the day?
I mean, one of the founders in our portfolio said to me, a pretty, it's both true and I think also a little naive, which is credit is just math, right? You get the data, you predict based on that data the forward cash flows and the resiliency of those cash flows of whomever you're lending to, and you lend them the money, and that's a sort of a mathematical exercise. I then, have had multiple discussions with a very smart chap who's been around this industry for a long time called Nigel Morris, obviously the co-founder of Capital One. And, he will talk about, he doesn't use the words art, but that there's a lot of art as well as the math, as well as the science to credit. And so I think the risk really of credit is that you go too fast, that you just rely on the math. You just rely on, well, I've seen the stream of cash flows and here's what I'm lending. And you don't take into account that little bit of artistry, if you like, which is probably not the right word for it. Nigel's a much more eloquent guy than I am. But I think the biggest risk to any fintech that goes, or a big tech that goes into lending is just too fast. I don't believe you can grow a lending business 10x year over year. So I don't think that's possible. So you just have to go slow enough so you learn the art. And you build up that muscle of making decisions not just based on the math, but based upon the art as well.
Yeah, and I would agree with Tom. I think for us in particular, given our focus on the mass market, the low to medium income household living paycheck to paycheck, our lending products tend to be, in the lending businesses we back, are not predatory, right? So the APRs are within reason. They are, we just fundamentally believe that that is an important approach, and as a result, it's more resilient to the market. When the credit crisis hits, those folks unfortunately might default, they're unable, but there's a much broader base of consumers and then enter into these kind of product offerings, and they're shorter in duration as well, so they also kind of at least manage through some of the potential downfall. That's how we've thought about our lending approach vis-a-vis other investors out there, and it's helped in terms of the cycles and being somewhat countercyclical in that regard.
Got it. Talk about exits for a second here. We've got all these big valuations. We've got a lot of VC money. Tom, you got to get liquid. You got to produce results. Is the ambition right now in your mind, sort of not for your company again, but just is it the IPO? Do you look at the exit as an M&A event? What's the time horizon for an entrepreneur these days? Do you worry about the market where it's at right now?
So from my perspective, what I see in the market right now is that definitely there are some early fintechs and some early neobanks have already they have exited already. Nothing great has happened really. I think quite few companies right now are aiming to scale to a few billions basically, and then try to go through an M&A process. And I think when it comes to IPOs, I think it's going to be significantly less, fewer of those. But I ultimately think that when people reach true scale, then anything other than IPO will be unthinkable almost.
Matt?
Yeah, I think that if you look at the kind of traditional financial services industry, you haven't seen a huge amount of large-scale acquisitions. Obviously, the Plaid acquisition recently was a huge one, but if you look at a lot of the traditional banks, I think that they have a harder time seeing the potential of truly like world-changing technology because they've heard the story that, hey, it's going to happen for, like you said, since the 90s. And I think that combined with kind of the revenue multiples and other things compared to where you see a lot of very large-scale acquisitions in kind of the traditional like Facebook, Amazon, Google, Apple kind of world. I think that at least our view, not only because of that, but because I think most globally transformational companies are not built to try to get some sort of acquisition. From a Remitly standpoint, and I think for most fintechs, because of the dynamic I just mentioned, you got to go in saying, we're going to take this all the way. We're going to build a very large-scale, eventually public company from a liquidity standpoint, and that's the only option. And then if something else comes along, you have to consider it. But life's too short to build a business that way if you really have a bold, audacious vision. And I think that especially in financial services, that's true for the reasons that I mentioned.
Building a good business actually takes quite a long time. It requires a founder to be still there, as you said, Tom, earlier. And I think if a founder is focused on exit quite early on, then will the mission be actually accomplished at the end of the day? I think not, because it takes such a long time.
Yeah. I mean, Tom, are you surprised to see Apple go into the business de novo by themselves? I mean, they do have some partners, but they didn't buy anything, right? And they'll buy Beats or something like that, but they won't buy a digital bank. Why do you think that is? Why do they feel so cocky they can do that themselves?
I mean,
they are Apple. You have $1 billion on the balance sheet, but
I don't know whether they contemplate M&A or not in this way. But if I was in their shoes, I think they're doing the very smart thing, which is they're starting with products which are much more likely regulated. Essentially, they're a facilitator of payments today, right? They're renting bank charters from Goldman and whoever else. So they're doing it in a very smart way, which is very light on the regulatory front. They're also doing it in a very smart way, which is, Matt said earlier, Apple Pay it wasn't such a big revolution. It didn't feel like such a big revolution. But actually, it is pretty meaningfully better than taking your card out, and it is pretty meaningfully penetrated, at least in my wallet, in how I pay for things. So I think they're providing a service which is better for the consumer. It's intrinsic and integral to what they've already built. I think they're actually making an incredibly smart set of moves. I have no insight as to how far it goes, but to your earlier question about big tech being in financial services, I think outside of China, I think the two most likely at this point to succeed and build something very large is actually Apple and Amazon. I think they're the furthest along in their thinking and probably the best place to make a real go of this.
I would comment, though, Amazon, while I do love and believe, they do have AWS, right? So you think about the migration to the core in the U.S. in particular for banks, having that access to data and then being able to, I think there's gonna be a lot of regulatory scrutiny as to whether that's viable in the long term, because they'll really own soup to nuts all the back-end financial data alongside the consumer data and merchant data. And I think at some point, there's gonna be a lot of intervention there, as there should be.
I think the only thing I'd challenge on the Apple kind of success, and the Apple Card certainly recently has gotten a lot more traction. I think they've put a lot more money into it. I think they've approached it in a lot more strategic way. I think if you were to look back, if it's been 5 or 10 years since they actually launched Apple Pay, I think that the adoption of that has been not the rate that at least other Apple-like products has gotten. And I think there's a question of why that's been the case. But I agree, it's the way they're approaching the Apple Card recently and doubling down on it, I think is very smart and strategic, and could be that step change better that we talked about earlier.
Plaid, $5.3 billion for 125 million of revenue. Does anyone think MasterCard needs to answer? Anyone?
Yes.
Bueller? Yes?
Should they is a different question.
I guess the question is, you know, you're building the infrastructure in this in big part of the banking space. You know, is that going to become something that becomes more of an M&A boom in your mind? You know, people need to buy those pipes, buy those connectivities.
Yeah, I don't know about MasterCard's acquisition plans, but I think generally I think it's sort of as I said earlier, there is a big opportunity there in this sort of in the space of settlements and infrastructure, creating a middleware, and helping to reap all those sort of cost efficiencies and then generate, and that's sort of, I mean, this comes back to the point that Tom made earlier. Who's going to capture that value that is being created? Is it just being passed back to the customer, and then, you know, that's sort of not helping maybe the company valuations? But then some of these things have network effects, right? So some, especially in the settlement, like what I described earlier, and this applies regardless of really what product category, when you have product providers on one side and point of sales on the other, and there is a middleware connecting them, the value of that middleware is for the points of sales is larger the more product providers are connected. And it's also larger for the product providers the more points of sales are connected. So I think there is a decent chance that you have quite a bit of value creation in the middle. And in that sense, I believe that quite a few players at the moment think about whether they should get into that, or what their role in this sort of new, financial economy, this sort of value chain setup is going to be, right? And you see some of the banks actually also in the incumbents redefining themselves from sort of a sort of product provider perspective to become the sort of, they call it the platform sometimes, so become the point of sale who kind of opens up to third-party products, uses people like us or in other product categories, other people, to connect to product providers and sort of take that part in the value chain, and, you know, others sort of focus on the product provider side. So I think there is a big sort of orientation exercise going on, and that is also maybe the driving force for some of those this M&A activity we're seeing.
But also,
Great.
I think the one last thing as well to say is that the three founders on the stage are all building large companies with large visions, and I think Matt said as well, will build towards being a public and independent company. And I think that's absolutely the only way. Well, I think it should be the core way in which founders think about their business, because otherwise you're solving for something rather than solving for the problem. You're not solving for your customer, you're solving for like your shareholders or your net worth, and that's a terrible thing to ever do as the founder. Having said that, the fact is not every fintech can go public, and that's just the fact of life. So there will be a wave of consolidation, whether that's a positive wave of consolidation whereby, you know, companies are exiting like Plaid at big multiples, or whether it's a sort of a 2001, 2002 wave of consolidation where there's lots of companies that are you know, missing out on funding and kind of going to the wall and getting bought for very low multiples. Who knows? But either way, there's definitively a great business for you, Steve, in the future as the M&A banker of choice in fintech, because you cannot take this number of companies public. It is just not possible. If anything, there's fewer and fewer companies going public, and the public markets are less receptive to smaller companies. If you look at the way in which research goes now and the way in which people trade stocks, if you're not a $5 to $10 billion public company, it's actually very hard to be public. Whereas that was quite different 20 years ago. So I think there's going to be a huge wave of consolidation. Whether it's positive or negative, I don't know. But for you, Steve, it's always going to be positive.
There you go. Well, listen, thank you, everybody. I think what we're hearing today is we're looking for the $1 trillion company, lots of winners in the $100 billion category. Paris FinTech Forum's coming back at some point in time, and FinTech is not dead. Give them a big round of applause. Thank you, guys.